Welcome to today's Breaking Market Explainer. Bitcoin just took a serious dive, and today we're tearing into the on-chain data to figure out exactly what's driving this crazy market volatility. It's July 28th, 2026, so let's just jump straight into the numbers.
Right out of the gate, here's the number that's literally dominating the tape today. A really sharp pullback to $63,500. If you've been following the space at all, you know this level is absolutely critical. It's a sudden shift that has the whole market asking, okay, what's next? And more importantly, why is this happening right now?
You know, when the market slides this fast, it really pays to remember that old adage, cash is a position too. Sometimes just taking a step back gives us the clarity we need to look at the data objectively, rather than getting totally swept away by the immediate panic of those giant red candles.
Let's look at the broader context. Right now, we're sitting at a 49.7% maximum drawdown from the October 2025 all-time high of over $126,000. I mean, when you see a haircut of that magnitude, understanding the localized resistance levels we're currently battling becomes incredibly important.
We actually just slammed right into a brick wall at that mid-July 65K psychological resistance level. The momentum just wasn't there for a breakout, and that resulted in a pretty harsh rejection that dragged us all the way down to our current reality at $63,500.
So what exactly triggered this rejection? Well, the primary culprit behind this short-term volatility is a massive, nearly $477 million outflow from ETFs. Think about that for a second. This isn't just retail traders panicking. This is heavy institutional capital temporarily moving to the sidelines.
The on-chain data paints a really stark picture of this selling pressure. You could see those deep red outflow bars, which honestly contrast so heavily with the massive $60.4 billion cumulative inflow we experienced before this. It's a severe but highly concentrated bout of institutional selling.
Let's actually break down the exact timeline of these outflows over the last 3 trading sessions. On July 23rd, we lost $225 million. The very next day, July 24th, we saw aggressive dumping peak at $240 million, but pay close attention to July 27th. The bleeding tapered off dramatically to just $12 million. The initial shockwave was fierce, for sure, but that really violent phase actually appears to be losing its momentum.
Still, you can't deny this aggressive outflow has taken a toll on market psychology. It's driven the fear and greed index all the way down to 34, planting us firmly in fear territory. Pair that with a relentless 60-plus day streak of US-based selling pressure, which we can clearly see reflected in the negative 0.10% Coinbase premium. Basically, the American market has been leading the charge downward for over 2 months straight.
But before we let that short-term fear completely take over the narrative, we really need to zoom out. Let's look at the macro perspective using the power law model. Just as a quick refresher, this is a mathematical valuation model using a Saint-Estèphe slope of 5.8. It basically projects Bitcoin's long-term fair value and historical price floors based on logarithmic growth. It's perfectly designed to cut through all this daily noise and reveal the structural truth.
And wow, when we run the numbers for 2026, the contrast is incredible. According to this model, not only are we 64.8% below the 2026 fair value of roughly $180K, but we're actually sitting 16.3% below the 2026 price floor limit. We are perilously close to last year's 2025 floor of roughly $54K. So, what's the critical takeaway here? Well, based purely on the power law band, Bitcoin has literally entered a historically deep value long-term accumulation zone. The mathematical models are flashing a major structural discount, which directly counters the short-term panic we're seeing today.
Further supporting this macro outlook, the network's vital signs are actually surprisingly calm under the hood. The MVRV ratio sits at 1.20, flashing neutral to undervalued. The 14-day RSI is at a completely neutral 47.7. Net unrealized profit and loss is hanging out in the hope bays at 0.17, and the 8-hour funding rate is a very neutral plus 0.004%. So unlike previous crashes, absolutely nothing is dangerously overheated here.
However, if the ETF bleeding continues and the fear persists, there are a few probabilistic support levels you really need to watch. Our first line of defense is the 61K to 62K zone. Below that is the core supply zone from 58K to 60K, and the absolute downside risk sits around 53K to 55K, which, by the way, nicely aligns with that 2025 power law floor of 54K we talked about earlier.
So given the huge contrast between the immediate shock of ETF outflows and these macro deep value metrics, the question you have to ask yourself for your own strategy is this: are you panicking alongside the short-term tape, or are you preparing based on the macro models? Is this just a falling knife or the ultimate accumulation zone? That wraps up our explainer for today. I'll catch you on the next update.